Hello, everyone, and thank you all for joining us during the Lytham Partners Consumer and Technology Summit. My name is Ben Shamsian, Vice President at Lytham Partners. Before we begin, for those not familiar with the Lytham Partners, we are the country's leading investor relations firm. With more than 2 decades of corporate access experience, we've built one of the industry's most diverse and effective platforms for connecting small cap companies with high quality and focused institutional investors, while creating framework of best policy practices and policies in all aspects of investor relations. Today's presentation is hopefully yet another example of where we bring value to multiple constituents. For our current presentation, I want to welcome Mark Palmer, FinTech and Digital Assets Equity Research Analyst at Benchmark. His 25-year career in financial services includes 13 years with BTIG and Berenberg Capital on the sell side, again, focused on financials and fintech and digital assets. Previously, Mark was on the buy side as an analyst and portfolio manager with firms such as BlackRock and Highbridge Capital. So with that, Mark, welcome. Great to have you here, and the floor is yours.
Thank you, and thanks very much for having me. The topic that I wanted to discuss today is one that we get a lot of questions about, which is given everything that we're seeing going on right now in crypto, digital assets writ large, how do I actually make money in this space? How do I evaluate these companies when the metrics, the KPIs, all of these different tools for measurement that I'm used to using may not be applicable to framing up these digital asset companies. And so I think the important thing to look at here is context. Where are we right now? What has changed? What is different than may have been a year ago? And of course, one of the biggest changes that we've seen as it pertains to crypto digital assets is the change in the government in DC, and in particular, the change at the SEC. For those who may be less familiar with the space, during the past 4 years, or the 4 years between 2021 and 2024, we saw Gary Gensler as the chair of the SEC cracking down on the crypto space in a manner that was almost the worst case scenario, because his approach was effectively regulation by enforcement for institutional investors to get involved in the space in any scale. What we see now is that completely different stance from the government toward the crypto space, much more conducive to not only the growth of the space, but importantly, more certainty. And what many institutions have said with regard to crypto is it doesn't matter as much about what the ultimate rules are, as long as those rules are in place so they understand where they can invest, how the government is ultimately going to oversee this space. And so what we have seen more recently is the Congress began to take up the legislative frameworks associated with crypto writ large. The first approach has had to do with stablecoins. And so we saw the enactment of the Genius Act. It was signed into law by President Trump. And so those companies that have exposure to stablecoins, the one that was front and center, certainly from a timing perspective, was Circle with its IPO, which really couldn't have been timed any better, given that the company went public just as the U.S. established a framework which not only favored USDC, which is Circle's stablecoin developed in partnership with Coinbase, but also laid down rules which were effectively taking Tether which is its biggest competitor, out of the US, at least in its current iteration. Tether has said that it's going to be coming to the US with the so-called Tether 2.0, which is going to be a version of that stablecoin that is compliant with the new framework in the US. Now, one of the companies that benefited from the enactment of the Genius Act was Coinbase itself, because it shares in the economics of the float underlying USDC in the form of interest income. At the same time, Coinbase owns a significant stake in Circle. And so it was really a significant catalyst for Coinbase when the Genius Act was signed into law, and also when the Circle IPO occurred. So that really is a game changer for Coinbase. It now is in a position to have a regular cash flow stream from USDC. And if, as we suspect, the adoption of stablecoins increases materially, Coinbase is going to be one of the names at the forefront in terms of beneficiaries from that development. With that said, we are now looking at the next big piece of crypto-related legislation, which is the so-called Clarity Act. This is much bigger, in our view, in terms of the potential growth of the crypto space, and importantly, the institutional adoption of crypto, because the absence of any sort of regulatory framework in the US, understanding what determines which cryptocurrencies are securities, which ones are not, and hence which regulatory body, be that the SEC or the CFTC, is going to be regulating a particular cryptocurrency. The absence of any sort of framework along these lines has meant that institutions have not known what the rules of the road are. They've stayed away up to this point. Crypto being that odd asset class where retail investors have led the way, really since crypto came into being in about 2009. So the potential to have institutions come into the space in size is enormous in terms of what that could mean, not only for the existing public entities in the space, but the potential launch of many new entities along those lines, something we're already seeing, partially in anticipation of the enactment of the Clarity Act. Now, the Clarity Act has passed the House of Representatives. It now moves on to the Senate. The thinking is that the Senate will be taking that up in September. President Trump has already said that he wants that bill on his desk so he can sign it into law. And so we have, a potentially huge catalyst with the Clarity Act. Now, who would benefit from this? Look at the companies that are set up, particularly to serve institutions in the space. This is where, we focus on a name like Galaxy Digital. Galaxy Digital is effectively a platform designed to accommodate the needs of institutions in the crypto space. It has for years been waiting for the point at which we saw significant institutional adoption, and its timing appears to be now. The company had been listed on the Toronto Stock Exchange for years. It recently uplisted to the NASDAQ in the US and also re-domiciled to the US. So it is in a position where it is not only going to be able to benefit from increased trading volumes, lending volumes, use of derivatives by institutions, but is going to be accessible by investors, including institutions, because of that NASDAQ uplisting. Um, what is also interesting about Galaxy in particular is that it's not just a play on crypto, it is also a play on one of the biggest drivers that we're seeing in the equity markets, which is the development of AI. Because Galaxy, by virtue of an acquisition that it made toward the end of 2022, when it looked very much like all things crypto were dead, it was able to scoop up a Bitcoin mining uh, resource in West Texas known as Helios, basically a Bitcoin mining farm that it was able to pick up for a song. I believe it was $60 million that they were able to acquire this. Now, as it turns out, Bitcoin mining farms can be converted into AI data centers that are going to be powering the growth of AI. And we're already seeing deals struck along these lines. So Galaxy has entered into an agreement with CoreWeave, the cloud computing platform, has contracted for the first 800 megawatts of power for data centers at Helios. Another name we just talked about that is a potential beneficiary of this big institutional push into crypto is Coinbase, because it also for years has been preparing for the point at which it would be able to serve institutional investors when they got to the point that they were very interested in entering the space in size. A big part of that is derivatives. And Coinbase, a few months ago, entered into an agreement to acquire Deribit, which is a global crypto options exchange. This would be the largest crypto deal in history at $2.9 billion in cash and stock. And importantly, it would position Coinbase to offer institutions the means through which globally we have seen more involvement, whether that be by hedge funds, other institutions, expressing their ideas on crypto via derivatives, options, futures, more sophisticated trades that institutional investors are more likely to put on. These are trades that globally have represented about 80% of all crypto transactions over the last few years. They have really not been front and center in the U.S., largely because, again, there's been a hostile regulatory environment toward crypto up until very recently. So Coinbase is definitely another name that falls into that category. One name that we have pointed to as representing kind of a bank shot trade on the institutional adoption of crypto is a smaller company called Exodus Movement, ticker EXOD. And this is a firm that years ago, and we're talking 2015, 2016, which in crypto terms is practically the Stone Age. The company developed a self-custodial crypto wallet. The reason why self-custodial matters in the crypto space is that crypto and Bitcoin in particular is a bearer asset, meaning that if you have the private keys that give you access to that crypto, then you own the crypto. If you lose the private keys, someone else has them. That person owns the crypto. So when you have a bearer asset along those lines, it is particularly important to be able to protect those private keys. Now, if someone were to buy crypto from Coinbase, for example, Coinbase is the entity that's going to be protecting those private keys. Now, Coinbase, has had a breach in the last number of months. There were not significant losses associated with that. The company did um, compensate those who were impacted by it. But we have seen some huge breaches in the crypto space writ large, which have resulted in billions of dollars of customer funds that were compromised. And so it's this fear, as well as the ethos within the crypto space, which says, if not my keys, not my crypto. If I'm not holding my own private keys, then it really is not my cryptocurrency. That led to the development of self-custodial wallets. Now, Exodus management recognized that there was really no way that they could monetize what is effectively a software-based self-custodial wallet. What we've seen typically is hardware-based self-custodial wallets, where someone actually has the unit, the physical unit that enables them to hold their crypto. Companies such as Ledger are the ones that issue these. But what Exodus was able to figure out was that they could offer services to the holders of their software crypto wallets, starting with exchange services. And so it created an API that exchanges, both centralized and decentralized, could plug into, so that they could provide the software wallet holders with crypto trading capabilities. Really put in a position where it had something unique as it pertained to the crypto space, and where it could offer a lot of value to wallet holders by giving them access to altcoins in a way that was much more efficient than they could find elsewhere. Now, what does this have to do with institutional adoption, especially because Exodus movement is focused on retail software wallet holders? In our view, one of the things that is likely to occur after the Clarity Act is signed into law, assuming that it will be at some point in September or October, is that institutions coming into the space, while they may be focused to a certain extent on Bitcoin or Ether or Solana, they're also going to be looking at the so-called altcoins. A lot of these protocols that were really under fire during the Gary Gensler years as chairman of the SEC. He was really going after a lot of the platforms that were out there. Example, Uniswap, where he would claim that Uniswap was effectively, facilitating the trading of securities in an illegal manner. Now, we have a head of the SEC who has said that virtually every cryptocurrency out there is not a security. And once we have that codified through the Clarity Act, that's really going to be the green light for institutions to come into the space. Now, it's not enough to simply have the SEC supporting the space now in that regard, because, of course, a few years out, we could see another change in the government, another change in the SEC, and we could be right back to where we were when Gary Gensler was the one making and enforcing the rules. And so that's where it's really important to have Congress act to pass the Clarity Act, to make it law, because it would be a lot more difficult for any future administration, Congress, or SEC to change things under those circumstances. So If we do see institutions flood into the space, get involved in altcoins, by as a result, we're likely to see altcoin prices pushed up significantly. What we have seen with Exodus movement historically is that when prices rise, that's when retail investors get involved. They are not value investors in this space, they are momentum investors. And so rising prices, in the case of Exodus, has historically translated into more monthly transacting users, more trading volumes, and ultimately more revenues and earnings. And so this is why I describe Exodus movement as being a bank shot play on institutional adoption, because even though it is not serving institutions, we believe that by extension, will benefit from the institutional adoption of crypto by virtue of rising altcoin prices and hence, better metrics for the company across the board. Um, Now, shifting gears a little bit in terms of what we're seeing out there right now, one of the biggest trends in the crypto space has been the launch of many crypto treasury companies, starting with Bitcoin treasury companies. And going back, I was the first equity research analyst to cover MicroStrategy back in 2021, when the idea of a company converting its business model so that its sole focus, or close to sole focus, was to issue securities and take the proceeds and buy Bitcoin was, considered crazy. And we actually believed that MicroStrategy had a really unique means of creating value, and the blowback from institutional investors, many institutional investors, was actually even surprising to me. And I've been in the space for a long time and seen a lot of blowback one way or the other. Um, but when MicroStrategy, now known as Strategy, had, over the next 4.5 years, the best performing equity in the market, significantly outperforming Bitcoin, significantly outperforming the S&P 500, significantly outperforming the next best equity in terms of performance, and with Nvidia. Then it became a lot more polarizing rather than one-sided in terms of the way that many institutional investors were looking at things. Now, you still had the detractors, but you have many proponents as well, and with some of those coming from very large institutional platforms. Some of the biggest mutual fund complexes as well. And so what we began to see starting last year was copycats of Strategy and of Michael Saylor with what he was doing. And these other platforms had somewhat different approaches to the acquisition of Bitcoin, how they went about raising capital, than Strategy and Saylor did. The first of these was Semler Scientific. Then we saw Metaplanet out of Japan. Metaplanet in particular was something of a phenomenon among retail investors, in particular in Japan. The reality in that country is that you have few avenues through which investors can gain access to any kind of yield. The Japanese central bank keeping interest rates at effectively zero. And so there is a tremendous amount of savings that is basically sitting in banks, earning virtually nothing. Metaplanet, by packaging Bitcoin in an equity wrapper, has changed things significantly in that regard, giving equity investors the option of buying Bitcoin through their platform and doing so in a leveraged manner. Now, Japan was really, again, close to an ideal setting to be launching this kind of strategy. Not only do you have the zero interest rate environment, but you also have a circumstance where the Japanese government has punitive taxation rates for those who are holding Bitcoin. Capital gains on Bitcoin are taxed in some cases as high as 55%, whereas the capital gains on equities such as Metaplanet are in the 20% context. And so, again, Metaplanet was in a circumstance where they could deliver Bitcoin to Japanese investors in a manner that not only gave them levered exposure to Bitcoin, but also did so in a tax effective manner. Hence, Metaplanet was the best performing equity on the planet in 2024. Since then, we have seen a breakout in terms of the number of Bitcoin strategy companies that are out there. Companies such as 21, Nakamoto, and a long list of others beyond that. What we are seeing is really, as I would describe it, a kind of a checkerboard, where on one side of that checkerboard, is a list of all of the different countries in the world where it's feasible to raise capital to buy cryptocurrencies. And the other side of the checkerboard is various cryptocurrencies, starting with Bitcoin.
All
And
right.
so with that, those are my thoughts
Thanks,
writ
Mark.
large with regard to crypto.
No, we appreciate this. This was great and quite informative. Thank you for your insightful presentation. Looking forward to having you at our upcoming events. Everybody, thank you for listening and have a great rest of the day. Thank you.